Welcome to PolicyCast, your go-to podcast for taxation, finance, and regulatory developments. In today's episode, we are decoding the big takeaways from the 56th GST Council meeting, which introduced a new wave of next-gen reforms. Joining us today is Sachhin Shinde, partner tax Grant Thornton Bharat. Sachin will help us understand what these changes mean for businesses, individuals, and the economy at large. So let's start. So my first question for today is, the 56th GST Council meeting has been a hot topic. What are the key takeaways from this meeting?
Indeed, this is truly a landmark meeting. The GST Council has delivered what I've called a very balanced and forward-looking set of reforms. The key theme is a shift towards a more simplified and business-friendly tax system, which is colloquially being termed as GST 2.0. There are two major areas of focus, first being the rate rationalization and the second being trade facilitation measures. Let's talk about the first one. The biggest shift is the move from a 4-slab structure to a more streamlined 2-slab structure with rates of 5% for essential goods and services and 18% for standard items. Also, a new 40% rate has been introduced for luxury and sin goods. On one hand, you have essential goods, FMCG goods, healthcare and pharma sector, renewable and agriculture sector related goods moving to a 5% bracket, and some consumer durables like ACs, televisions, and various construction items like cement moving into a 18% bracket. These reductions directly lower purchase costs, which is a big boost for discretionary spends and consumption. Especially in a price-sensitive market like India, it is expected to substantially ease inflationary pressures on households. On the other hand, luxury goods like large cars, SUVs, high-end motor vehicles are now taxed at 40%. This embeds a sense of progressivity into the tax system and offsets the revenue impact of the rate cuts elsewhere.
Right. So what about the operational and trade facilitation measures? This is often where businesses feel the most friction. What's your point of view on that?
I agree, and that's right, that the council has made a very welcome move here as well. Firstly, on the liquidity front, it actually proposed to introduce the risk-based provisional refund mechanism, wherein 90% of the refunds would be sanctioned provisionally just within 7 days. This will ease working capital stress and unlock cash flow for businesses. Also, some important amendments and clarifications are proposed on certain procedural areas. For example, in case of credit notes for post-sale discounts, place of supply for intermediary services. This is going to help reduce compliance complexities and legal ambiguities. The commitment for operationalization of the GST Tribunal is another huge step. The Tribunal will start accepting appeals by end of September 25, which provides a long-awaited avenue for dispute resolution. This will offer taxpayers greater certainty and help reduce the significant backlog of litigations. Additionally, the proposal for simplified GST registration scheme for small and low-risk businesses is expected to allow completion of GST registration in just 3 working days. This is also a massive step towards enhancing the ease of doing business.
Interesting. Yeah. Let's break this into 2 parts. What are some of these immediate next steps and some of the key transitional challenges that you think businesses should be prepared as they implement all of these updates that are announced in the meeting?
Rightly said. So it's very easy to make those changes, but the businesses needs to be much more prepared to address the impact. So GST 2.0 reforms, particularly the rate rationalization, is a massive change. Though it may look simple, but the groundwork that needs to be done by businesses is huge. While these reforms are largely positive, they also present a new set of challenges that businesses need to navigate, mainly because businesses just have a few weeks to get ready before the new rate kicks in on 22nd of September. Therefore, today's businesses are required to be much more agile than ever before in terms of being ready with clean and reliable data, enabling a quick impact assessment, updating the ERP system, and making changes to business processes and supply chain. And it doesn't stop there. Companies are also expected to revisit their pricing strategies, renegotiate contracts with suppliers, with customers, at times even with governments, to reflect all the changes which have happened around the rate of tax. And all this in less than 2 to 3 weeks. It's really a lot to take on in such a situation, and without agility and a well-planned, thought-out strategic approach, the businesses might run into a whole host of challenges during this transition phase. Take, for example, a large multi-locational business. For instance, the kind of shift that needs to be done from a logistical and technological side is huge. Managing the inventory levels across regions, staying compliant with relabeling norms, avoiding unwarranted accumulation of ITC, financial leakages, and this is just to name a few. We also need to, keep in mind the risk of anti-profiteering scrutiny. While the Honorable Finance Minister has stated that there is not going to be any anti-profiteering provisions around, but the media has stated in multiple places that the authorities are going to keep a watch. And with a number of goods moving into a lower tax bracket, businesses will now be under pressure to pass on these benefits to consumers. So the government, though having stated that they are not going to bring in anti-profiting provisions, but are going to keep a close watch to ensure that the benefit is actually passed on to the customers, and non-compliances may not only pose financial risks, but also reputational risks. Therefore, honestly speaking, this is a tightrope walk for businesses that they may be prepared for, which is, balancing their compliances, operational continuity, strategic responses, all this with a compressed timeline. So success will primarily depend on how quickly and effectively organizations take those necessary actions on.
So while the reforms are certainly a step towards the right direction to boost the economy, but do you think that there are still any loose ends which have not been addressed?
Absolutely. Actually, the government has rightly addressed and the direction is right. But not all the ends have been tied up. For example, if you look at a little closer, there are certain areas that needs to be still addressed. As a major reform, the GST Council has decided to end the levy of compensation cess. The cess is now going to be merged with the 40% GST rate. While this move does make the tax system simpler, but it creates a major concern for auto dealers who've stocked up heavily for the festive season. They've already paid the cess on the current inventory, but the government is not intending to provide refund of this cess. The cess then becomes a cost in the supply chain, and the objective of reducing cost and affordability for consumers may not be completely achieved. Another major challenge that may arise is working capital blockage due to the rate reduction. When goods are moved from a higher GST slab rate, which is 12% or 18%, to a lower one of 5%, businesses may have accumulated ITC. Now, official FAQs have clarified that this type of accumulation, which would arise from current rate reductions, would not be eligible for refunds. This might create a significant working capital crunch for businesses, forcing them to carry forward their credits for a much larger period of time. Similarly, the council has made certain services such as hotel rooms with a tariff up to a certain value subject to a 5% GST rate and no provision for input tax credit. Even exempted services like life and health insurances face the same issue. These rate reductions and exemptions are though intended to lower cost for consumers, but for businesses providing these services, the tax paid on their procurement till date cannot be offset. But what does it mean? This means that the current eligible credit balances now turn into a direct hit into the profitability, eating into profit margins. Additionally, the overall reduction in GST rates and liabilities will also have a direct reduction in the amounts of subsidies and incentives under the category of budgetary support schemes which have been rolled out by the central government, and also the state incentive schemes introduced by the various state governments. All these unaddressed issues can't be tackled in isolation. They are connected, and therefore they need to be represented collectively to the government, either through industry bodies, trade associations, policy forums, and all this will be critical for making sure that all the loose ends are tied up. And only then can we ensure proper deliberation and a meaningful redressal of all the issues around rate reductions.
That brings us to the last question of this podcast. If I were to ask you the single most important message which you would like to share with our clients and the larger audiences about these reforms, what would that be?
My final message is that these reforms are not just a tax adjustment or a reduction in rate of tax. It's a strategic package, and only with an objective of strengthening India's economy and building a Viksit Bharat. Looking at the global geopolitical scenario, the changes are designed to stimulate consumption in mass market segments, boost manufacturing, and improve investor confidence, all of which are extremely critical for making India Atmanirbhar or self-reliant. And this was effectively getting reflected in the budget speech, in the Honorable Prime Minister's speech on the day of independence. So the GST rationalization is indeed emerging as a strategic tailwind for India's global competitiveness, simplifying compliances and reducing costs across key sectors like manufacturing, healthcare, and mobility, by boosting domestic consumption and easing working capital pressures through provisional refunds and lower rates. It strengthens internal demand, a critical buffer against external shocks such as US tariffs and global trade headwinds. While it may not fully neutralize the geopolitical risks, it enhances investor confidence by signaling policy stability and a pro-growth tax regime. In true sense, GST 2.0 positions India as a much more agile and a resilient economy in a volatile global landscape. These reforms address past anomalies while also being forward-looking in their alignment with macroeconomic goals. Businesses should see this as an opportunity to review their supply chains, leverage the improved liquidity from faster refunds, and capitalize on the enhanced market demand. It truly reflects the maturity of India's tax framework, balancing affordability, equity, and revenue.
That brings us to the end of this episode of PolicyCast. A big thank you to you, Sachin, for breaking down the GST 2.0 reforms and what they mean in practice. I'm sure our listeners will find these insights very, very valuable. Stay tuned for more conversations on tax and regulatory developments. Until next time, thank you for listening. Thank you, Sachin, and thanks.
Thanks, Navjot. Thank you, everyone.